Hello everyone. Our first topic under business decision analysis is cost volume profit analysis. What does it mean? What kind of analysis is this? Actually, it's an internal decision making tool. As part of our day-to-day business affairs, managers of the business need to take plenty of decisions, right? So this is one of the kind of decision making tool. Why we are using this one for? Actually, this one can be used for internal decision making process. That means we cannot use it for external financial reporting purpose. That means audited financial statements to be submitted to the government and respective authorities, especially in US for Security Exchange Commissions, in India if it is SEBI, Security Exchange Board of India, and here in US Internal Revenue Service, but in India let's say Income Tax and GST Authority are audited financial statements to be submitted, but not that purpose. Actually this is for internal decision making purpose only we are using cost volume profit analysis. So what actually this one measures? Cost volume profit analysis. That means this is a kind of internal decision making tool which is used to analyze the relationship between cost, volume and profit. That means the relationship of revenue with cost and profit. So this is what gonna measure in this topic. So in this topic we are going to discuss these 5 subtopics. We'll start with CVP analysis of single product company. Secondly, we will discuss the CVP analysis of multiple product company. I'm not discussing in order. So, and third, margin of safety, sensitivity analysis and other kind of decision. All these topics to be discussed under this topic, cost volume profit analysis. Now let's start with the CVP analysis of a single product company. Say for example, we have taken an example of a manufacturing company. Actually, what is their business? Producing and selling carton box. So the company name is Box Gallery. They produce and sell carton box. How many units they used to produce and sell? That is 2000 units on a monthly basis. Okay, in order to produce and sell these 2000 units, they have to spend a monthly fixed cost of $6,000. Okay, apart from that for each unit of output, production and sales, they have to pay $8 as well. For each unit, $8. So that means here we are going to separate our cost into variable and fixed. With this help of variable cost and fixed cost only, we can analyze the CVP, right? So as we know that as a manufacturing company, what are the variable costs would be there over there? As we know that in order to produce the product, let's say carton box, we have to pay $4 of material cost for each unit. For each carton box, we have to pay $4 of material cost. Apart from that, in order to produce each carton box, they have to spend $2 of labor cost as well for each unit, right? So apart from that, indirect cost also need to be, these two costs are direct cost. That means that is related to that, directly related to that particular carton box. But indirect cost also we need to be spent. That means variable indirect cost. Let's say overhead, we used to say overheads. Indirect costs are overheads. So that means in order to say for example, if you are producing 100 units, so we have to spend some whole amount, let's say rent, or we have to pay salesman commission. So these costs are indirect costs, right? So here we have to pay indirect cost, indirect manufacturing related cost of $1.75 for each unit of carton box, and apart from that $0.25 of variable selling and administration related cost. Altogether, in order to produce and sell each unit of carton box, they have to spend $8 of variable cost. We used to call variable cost per unit or unit variable cost. Okay. So next, as we have already discussed, in order to produce 2000 units, we have to pay $6,000 of total fixed cost. Even if you are not producing anything, that need to be paid. If you are producing 1 unit also, totally we have to pay $6,000. So here the costs are segregated into variable and fixed. Fixed costs are given in total and variable costs are given in per unit basis. Apart from that, anyhow, we are producing for the purpose of selling this product to the customers. So for each carton box, we have set a price as $20. Each carton box we used to sell for $20. This is the scenario. Based on this particular scenario, we are going to conduct the CVP analysis of a single product company. So as part of our CVP analysis, our first point we have to take into account is break-even point. Before discussing what is break-even, we will make with available resources, with available details, we are going to prepare a contribution margin income statement. You have already know how to prepare a contribution margin income statement, whether it is a manufacturing or trading company. Here we are preparing the contribution margin income statement of a manufacturing company. So let's prepare the contribution margin income statement. I am writing in short CM income statement, contribution margin income statement. Okay. So as we know that in any contribution margin income statement, we will have cost and revenues, right? So we'll start with revenues, we will deduct cost, we will arrive at profit. But here contribution margin income statement is an income statement which is prepared by separating variable cost and fixed cost. Then our cost separation will be based on cost behavior, that is variable and fixed. Anyhow, it's an income statement. What is the difference between this income statement and normal income statement? There we are preparing by separating the cost as product cost and period cost. Here variable cost and fixed cost. That's only the difference. If you are producing and selling the same units, any income statement, the profit will be same. Okay. So anyhow, we are going to prepare the contribution margin income statement. So in any income statement, we'll start with sales, right? So sales. How many units we are going to sell over here? That is 2000 units, right? 2000 into selling price would be $20 each. 2000 into $20. How much it would be? It would be $40,000, right? From this sales, we'll deduct variable cost first because this is a contribution margin income statement. So each unit $2,000. Then for 2000, for each unit $8, right? For 2000 units, how much it would be? 2000 into $8. Actually, variable costs are cost incurred proportionately to the activity. Here our activity is sales. That's why we are incurring based on our sales. If you are selling 1 unit, 1 into 8 will be our total variable cost. If you are selling 2 units, 2 into $8 will be our variable cost. If you are selling 2000 units, it will be 2000 into $8 would be $16,000, right? From $40,000, deduct $16,000, it would be $24,000. We call it as contribution margin. Contribution margin. Why it is contribution margin? Why we have given this particular name? It's an amount which contributes to cover fixed cost and profit. From this amount we have to cover fixed cost. The rest of the amount will become our profit, right? So from this amount we can calculate like sales minus variable cost is contribution margin, right? From here, see, selling price minus variable cost per unit. These are in unit per unit basis and these are in total. So if sales minus total sales minus total variable cost is equal to total contribution margin. We used to say simply contribution margin. And if you are deducting selling price, this is per unit, the variable cost also per unit. So selling price minus variable cost per unit, that will be contribution margin per unit, or we used to say unit contribution margin. That would be how much? 20 minus 8 is equal to $12. If you are multiplying 2,000 with $12 also we can get $24,000. In this manner also you can calculate contribution margin. Anyhow, we are going to deduct fixed cost from this contribution margin in order to arrive at the profitability, right? So as we know that our fixed cost, any unit we are going to produce, our fixed cost would be 6,000. This is never going to change, right? So if you are producing and selling 1 unit, our total fixed cost will be 6,000. If you are producing and selling 10 units only, our fixed cost would be total $6,000. If you are not producing anything also, our fixed cost would be 6,000. So here our 2,000 units, whatever, our fixed cost would be $6,000. This would be fixed, right? That's why only in the name fixed. So 24,000 minus 6,000 is equal to $18,000. What we call for this is profit. What profit? We used to call operating profit. Operating profit. Let's say operating income or operating profit. Otherwise, we call it as earnings before interest and tax. Earnings before interest and tax. Also, we can assign the name, right? So, from this, we have to deduct if there is any interest. First of all, earnings before, earnings means profit, profit before interest and tax, before giving the interest and interest to the debt holders and tax to the government authority. This is the amount before giving interest to the debt holders and tax to the government authority. So first of all, we are prioritizing interest. So in CVP analysis or internal decision making process, interest will be ignored. That means finance cost will be ignored. This is an assumption of CVP analysis. That's why we are put it 0. So nothing to be deducted as interest. So 18,000 minus 0 is equal to 18,000 itself, right? So what we call for this, earnings before tax. That means profit before tax. Otherwise we can say pre-tax profit, right? Pre-tax profit. Pre-tax profit, right? That means EBT, earnings before tax, otherwise profit before tax, otherwise pre-tax profit. In any way you can call. From this pre-tax profit, that means this is the profit before paying tax to the government authority. So from this we have to pay a tax of, assume that we are in a country, let's say in US, our income tax rate is 40%. Assume that 40%. Our tax would be 18,000's 40%. How much it would be? That would be $7,200, right? So when we deduct 7,200 from $18,000, our after tax profit will get, right? It would be $10,800. What we call for this? This is pre-tax profit. This is after tax profit, right? So this is how we prepare a contribution margin income statement, as we have already discussed. But in CVP analysis, our first scope is to calculate break-even point. What is break-even point? Here, in this case, our company is running with a profit, right? That means pre-tax profit of $18,000 and after-tax profit of $10,800. Anyhow, we are in profit, right? So here, we know that operating profit and pre-tax profit are same. That's why here onwards, we used to call here, when we deduct fixed cost from contribution margin, we used to call pre-tax profit. No need to be confused. Why? Here in pre-tax profit, here in CVP analysis or internal decision making process, pre-tax profit and operating profit are same. In reality, it's not same. In every cases, these are not same. But here it's same only because we are ignoring interest. But in some other cases, other than the internal decision making process, interest would come. At that time, operating income and pre-tax profit won't be same. Okay. Now, anyhow, here pre-tax profit and operating income both are same. Here onwards, we used to call this pre-tax profit, and from that pre-tax profit, if we deduct tax amount, we will become at after tax profit. We won't discuss anymore about operating profit here in CVP analysis. Instead of that, we used to call pre-tax and after tax profit. Okay. Now, what is break-even analysis? That's we are looking for. Break-even analysis. So break-even analysis means, break-even means it's a point where there is no profit or no loss. That means, in short, instead of this profit or this, whatever, both are same, right? So instead of this profit, we used to call, here onwards, we used to call this as pre-tax profit as well. So this is 0. Now we are in break even. In order to be here 0, okay, in order to be here 0, that means our pre-tax profit to be 0, how many units to be sold and how much dollar amount of sales to be made. This is what we are gonna discuss about break-even point. Okay, so we are going to calculate what? Break-even point, right? Let's say how to calculate this break-even point. We have some sort of assumptions in CVP analysis that in any contribution margin income statement, some item remain constant over there and some item will change. Let's see what are the item gonna change and what are the item remain constant. As we know that now we are selling 2000 units, right? So 2000 into $20, right? That will be our sales, right? This will be our sales. Instead of this, if you are selling some other units, this will change or not? No, this is never gonna change. And what about this? Is this will change? No, variable cost per unit also not gonna change. If any quantity changes, we'll change the quantity over here. And if the selling price and variable cost per unit never changes, contribution margin per unit also not going to change. And what about the fixed cost? Fixed cost total never gonna change. I'm not talking about per unit. So total. So variable cost per unit never gonna change and total fixed cost never gonna change. So as we know that break-even point is a point at which our operating profit will be 0. That means total revenue equal to total cost, right? Anyway, we know that this cost will be same here as well. That means what we are going to calculate? We are going to calculate any unit of sales. We don't know X amount of units. Okay, we don't know that. This is in question mark, right? So it's an X amount of units. With that unit, we are going to sell. Sorry, we are in a position to 0. That means operating profit will be in 0, right? So we are going to calculate that units or that sales value at which we are in break even, right? So as we know that fixed cost will be $6,000 here and any units, right? And what about the contribution margin? Contribution margin per unit never gonna change. Then what will change? The units will change, right? Units gonna change. So for units, we can put it as units itself. Okay, units, simply units or X or Y, whatever. So for easiness, we can put it X. Okay. So here we are selling X amount of units. We don't know that units. That's why only we are putting as X, right? So this is never going to change, but this will change. This will be some other units. Okay. So that we don't know. That's why we are putting X. X into this one never changes, right? X into $12, right? This is our contribution margin. So this is our contribution margin. From that contribution margin, if you are deducting fixed cost, will arrive at profit, right? And when it comes to here, we can fill in the same manner. Variable cost per unit never gonna change. Then what will change? This 2000 will change, right? 2000 instead of 2000 it will become X, right? X into how much? $8, right? And what about sales? Sales, the units will be something else in order to be break even, but this will never changes, right? So for that also x, we are putting x into 20. So see here the units are same, so instead of that we are putting x because we don't know that particular unit, right? So anyhow, x into 20 is our sales. From that x into 20 we are going to deduct x into 8, that means contribution margin. So from this sales we are going to deduct this contribution margin. We will arrive at variable cost, from this variable sales we are deducting this variable cost, we will arrive at contribution margin. So x into 12 is our contribution margin. From this contribution margin, if you are deducting $6,000 of fixed cost, that never gonna change for anywhere. So this is contribution margin. From that contribution margin, if you deduct, we will arrive at what? Profit. We can call operating profit or pre-tax profit. Both are same here in this case, right? So now we are going to solve the value of x. What is x? The units, right? So how to calculate that? We can calculate over here, okay? So x into 12, x into $12, what is that? This is our contribution margin, right? From this contribution margin, if we deduct 6,000, that means we are deduct $6,000, where we are gonna reach? We are gonna reach at profit. What is our profit? That is equal to 0. This is our profit. So contribution margin minus fixed cost is equal to 0, right? So here we know that x into 12 means 12x. We can call in same manner as well, like 12x minus 6,000 is equal to 0. This is for easiness, I have written in this way. So 12x minus 6,000 is equal to 0. Then 12x is equal to, now it's time to solve the value of x, right? So what does it mean by x? This is number of units to be sold, to be here as 0, right? 12x is equal to, we are bringing this minus 6,000 to rightwards, right? So it will be here, already 0 is there. So when it bring here, it will become plus 6,000, right? Plus 6,000. Now x is equal to 6,000 divided by 12 into x. This is multiplication. When it comes to right side of the formula, it will become division, right? So divided by 12, x is equal to how much? 6,000 divided by 12 will be how much? 500 units, right? Just take calculator and calculate it. So you will get 500 units, right? So what does it mean by this 500? This 500 means if you are producing and selling 500 units, our profit will be, that means pre-tax profit or operating profit, both are same, okay? So our profit will be 0, right? And what about the units? How to calculate that? How to calculate our units, our sales value? We already have the break-even sales units. What does it mean? At this sales units, our profit will be 0. So this is our answer. If someone asking a question, a manager asks, what is our how many units to be sold to become break-even? So we'll say this is 500 units. So they will ask again one more question. What is the break-even sales value in terms of dollar? We just need to multiply this unit with what? The selling price. We'll get sales value as well, break-even sales value. So this is break-even sales units, and break-even sales value is equal to what? 500 into selling price, $20. So that will be how much? $10,000. What does it mean by this and this? This is the number of units to be sold to be break-even. This is the value of sales to be made to be break-even, right? So how to, this is the answers, right? But if you want to reconcile, I mean if you want to check if you are getting a profit 0 over here once we selling 500 units. What you need to do? We just need to prepare a contribution margin income statement based on this 500 units. Then we will get a profit over here as how much? 0, right? So let's reconcile it. So I'm writing only the final figures. So first of all, sales, how much? 20 into 20, 2000 into $20 is current sales, but break-even sales how much? Break-even sales units into $20. So 500 into $20. Instead of here, we'll put 500. Everywhere will change as 500. That's it. So 500 into 20, how much? $10,000. From that 10,000, what you have to do? You have to deduct the variable cost. So for 500 units, you have to calculate the variable cost. 500 into $8 equal to how much? 500 into 8. $4,000, right? And from the sales, you'll deduct variable cost. You'll get contribution margin of 6,000. From this 6,000, what we are going to deduct? Fixed cost. That will be same in every case. Here, everywhere, right? So we are going to deduct this 6,000. From this, we'll deduct this. So our profit will be 0. Our answers are correct, right? So now we have taken this value out of this contribution margin income statement, right? But we need one formula for this. For examination purpose and all, we have to calculate in fingertips, right? We have to calculate in short span of time, right? For that purpose, we have to develop a particular formula. So using this final item, we are going to develop one formula out of it. What is this? X means break-even sales units, right? Break-even sales units. So X is equal to break-even sales units. Break-even sales units. What is this? 6,000. Every time it's 6,000. It won't be some other amount. So what is 6,000? 6,000 is our fixed cost, right? Fixed cost. Fixed cost. And what about this 12? 12 means this. Here we can see 12. What does it mean? Unit contribution margin or contribution margin per unit. This is how we calculate break-even in units. And what about break-even sales value? Without taking the formula, we can calculate. But we have to develop one formula also for this purpose. Without formula, what we can do? Once we get, see, with this formula, we are going to calculate break-even sales units and also values. Okay, so as we know that fixed cost is 6,000. It's already there, but still we are just repeating. So fixed cost, as we know, 6,000, right? What is our unit contribution margin? That is $12. $12. It would be 500 units. So this is so easy to calculate break-even in sales units, right? And what about the value? We just need to multiply this 500 with the selling price of $20 of each carton box. That will be $10,000. So without the formula, we can calculate break-even sales value. But even though we are going to develop one formula also for what? For break-even sales value. Now we already have the formula for break-even sales units. Okay, we have already developed one formula or shortcut to calculate break-even sales units, right? Now it's time to calculate or develop one formula. For what? For calculating the sales value. What sales value? Break-even sales value. That means here we need to get 0. I just change the scenarios, like simply when we deduct fixed cost from contribution margin, it's operating income actually, but here I'm writing as pre-tax profit. It's only because both are same in this case, as we are ignoring the interest, right? So this is pre-tax profit of $18,000 and we are deducting tax 7,200. You'll arrive at after tax profit. So this is the current scenario of company, but we are going to calculate how much dollar amount of sales to be made to be here as 0. That means to be break even, right? So instead of $18,000, how much dollar amount to be made here instead of this. Before, what was our calculation? How many units to be sold, how many quantities to be sold to be 0 as here, right? So now it's time to calculate break-even sales dollar values, okay? Break-even sales revenue, otherwise you would say. So as we know that here we are developing everything with the help of logic instead of simply giving the formula to in front of you and putting the values. That won't be good enough, right? Instead of that, we have to develop based on the contribution margin income statement. We have solution for everything here in the contribution margin income statement. In CVP analysis itself, we are analyzing the relationship between all those things, right? Now, we know that our fixed cost never gonna change, right? And apart from that, as we know that we are going to calculate the sales value, right? Sales value. We don't know the sales value here. Suppose if you are putting here as sales, here we know that here the variable cost will come. That will be certain percentage of this, and here contribution margin will come. That will be certain percentage of sales. Okay, so if you calculate or analyze that particular relationship, we will easily calculate the break-even sales value. As we know that we have selling price of how much? $20, right? And unit variable cost of $8, right? And unit contribution margin of $12. From this, we are going to develop our proportions, right? Here, see, the sales is how many percentage of sales? This actually selling price means sales of 1 unit, right? This is unit variable cost of 1 unit. This is contribution margin of 1 unit, right? So here, the sales will be 100% of sales. But here, what about this? This 8 will be how much percentage of $20? You would say 8 by 20. 8 by 20, right? 8 by 20, how much percentage it would come? That would be 40%. In fraction, you would say 0.4, right? Mathematically. And what about this? What about this? This is 12 by 20, right? 12 by 20. That means this unit contribution margin or contribution margin, how much percentage of this? That will be 60%. This will follow everywhere, because when the unit changes here and here, it will be same. That's why in every cases contribution margin per unit, contribution margin ratio and variable cost ratio. What does it mean by ratio? How much percentage of sales belongs to variable cost? That is variable cost ratio. And how much percentage of contribution margin belongs to sales, right? That is contribution margin ratio. So this is our contribution margin ratio. This is our variable cost ratio. This will follow everywhere. So here 8 by 20, here it will be 40%. 12 by 20, that is here 60%. So it will follow everywhere, right? In any kind of units. If any other unit come over right side, the percentage of sales belongs to variable cost and contribution margin will be same. So we are following this. So as we know that sales, if here it is sales, if here it's $100,000, 40% will be here, $40,000 will be here, and $60,000 will be here. If it is $1 million, here it will be how much? $400,000, and here it will be $600,000. But here it is, unfortunately, it's sales X, Y, whatever. So if it is sales, that will be, here the amount will be 40% of this, How to write that? Sales into 0.4, right? That is 40%. Sales into 0.4. Otherwise, mathematically, we can call 0.4 sales. Both are same, right? And what about this? This would be how much percentage? Contribution margin will be 60%. So this sales, whatever it is, that sales 60%. So sales into 0.6, that would be 0.6 sales we can call in short, right? So now see, this is our contribution margin. This is our fixed cost. When we deduct, in order to arrive at here, sales minus variable cost, contribution margin. That means from one sales, we are deducting 0.4 sales. That means 0.6 sales. Otherwise, you would say sales into 0.6, right? This is our contribution margin. From this contribution margin, if you are deducting fixed cost, we will arrive at profit. But our profit will be 0 here because this is break-even sales. That means here in break-even, our contribution margin is equal to our fixed cost. Then only it will become 0 over here, right? So here we know that this is our contribution margin, this is fixed cost, is equal to profit. So we are going to develop here. See, this is our contribution margin, sales into 0.6. That is our contribution margin. From this contribution margin, we are going to deduct $6,000 of fixed cost. We will arrive at profit. Here our profit will be 0. Why? We are in break even, right? So instead of this, mathematically we can give 0.6 sales for easiness, right? 0.6 into sales means 0.6 sales. If you are writing here this manner or this manner, both are equal, right? From this we will deduct $6,000, we will arrive at 0, right? So now it's time to calculate sales. 0.6 sales is equal to, now we can move to the respective areas, right? So now 0.6 sales is equal to what? We are bringing this to rightwards, right? So here it is minus, it will become plus right over there, right? And 0.6 sales equal to 6,000. Here it's already 0 is there, there is no value for 0. So 0.6 sales equal to $6,000. Sales is equal to 6,000. What we need to do here, 0.6 into sales. Here it's multiplication. We are bringing this to rightwards. Then it will become division. Multiplication will become division, right? 0.6. So sales is equal to 6,000 divided by 0.6. That would be how much? $10,000. Do you remember previously our break-even in unit was? Break-even in unit was, we have developed a formula for this, right? What was that? Fixed cost divided by unit contribution margin. How much it was? Fixed cost, as we know, $6,000, and unit contribution margin was $12. Our break-even in unit was 500 units. So this was our break-even in units. In order to get break-even in values, dollar values, what we were done, 500 units into respective selling price, right? So 500 into 20 is equal to $10,000. This is one way, right? This is the second way. That means with the help of formula, we are going to calculate break-even sales value as well, right? So this should be the base for our, so instead of developing in such a manner, even if you are forgetting this formula, you have the logic to develop this. That's why we are discussing in this manner, right? So break-even sales, this is not simple sales, this is break-even sales. So the formula will be break-even sales dollars, right? Values, this is units and this is values, right? So this is our fixed cost, right? 6,000 is our fixed cost. And what about 0.6? 0.6, we know one thing. Do you remember this? What is that? This? Do you remember? 0.6. What we call for that? contribution margin ratio. What does it mean? How much percentage of sales belongs to contribution margin. That means this is how much percentage of this. This is how much percentage of this. That is contribution margin, right? So it is 0.6. Here we know we are writing a formula. That's why we are not giving the value over here. Instead of that, we are giving unit contribution margin. Sorry, unit contribution, not unit contribution margin ratio. CMR. Right? So this is how we calculate break-even sales values. So this is the formula to calculate break-even sales units, and this is the formula to calculate break-even sales value. So instead of by heart or memorize the formulas from the textbook, you can apply in this manner as well in order to develop the break-even analysis. This is the break-even analysis of a single product company.